Module 3. Where to invest. Now that you understand why investing is crucial, let's explore your options. India offers several asset classes for investment, each with its own characteristics. We'll look at fixed deposits, government securities, equity, real estate, and gold. Understanding each will help you make informed decisions about where to put your hard-earned money. Let's start with the safest options and work our way to higher return investments. First, let's talk about fixed deposits and bonds. These are debt instruments. You're essentially lending money to a bank or company, and they pay you interest. FDs from major banks are very safe, backed by deposit insurance up to 5 lakh rupees. Returns typically range from 6 to 8% for bank FDs. Corporate bonds and NCDs from good companies might offer 8 to 10%. The significant advantage is predictability. You know exactly what you learn. The disadvantage? Returns barely beat inflation and interest is fully taxable as per your income slab, suitable for emergency funds and short-term goals. Government securities include treasury bills, government bonds, and PPF. These are backed by the Indian government, the safest borrower. Returns typically range from 7 to 8%. PPF is particularly attractive with tax-free returns. The 15-year lock-in might seem long, but for retirement planning, it's excellent. RBI Retail Direct now lets you buy government bonds directly. These are ideal for the conservative portion of your portfolio and for those in high tax brackets who can benefit from tax-free instruments. Now, equity, stocks and mutual funds. This is where wealth is really created over the long term. When you buy stocks, you're buying ownership in companies. When these companies grow, your wealth grows. Historically, Indian equities have returned 12 to 15% annually over long periods. Nifty 50 has given about 12% CAGR over 20 years. But, and this is important, equity is volatile. In any given year, you might see gains of 30% or losses of 30%. The key is staying invested for the long term, at least 7 to 10 years. For most people, it is advisable to buy equity mutual funds rather than buy stocks directly. Real estate is a favorite of Indian families. There's something comforting about owning physical property. Returns are difficult to quantify because they vary hugely by location and timing. Some areas have given 15 to 20% annual appreciation. Others have been flat for decades. The advantages are potential rental income and leverage through home loans. The disadvantages are significant. Huge capital requirement, very low liquidity, maintenance costs, tenant issues, and property taxes. You can't sell half a flat when you need money. Good for those with large capital and long horizons, but shouldn't be your only investment. Gold and silver have been Indian favorites for centuries. We're the world's largest consumers of gold. Over the last 20 years, gold has given returns of about 10 to 11% annually in rupee terms. It's a good hedge against inflation and currency depreciation. You can buy physical gold, gold ETFs, or digital gold through apps. Silver is more volatile but also has industrial uses. The disadvantage is that gold doesn't generate any income, no interest, no dividends. It only returns a profit when you sell at a higher price, suitable for 5 to 10% of your portfolio as diversification. Let me show you a comparison of all asset classes. Fixed deposits, 6 to 8% returns, very low risk, high liquidity, fully taxable. Government securities, 7 to 8% returns, lowest risk, medium liquidity, tax benefits with some instruments. Equity, 12 to 15% long-term returns, high risk but reduces over time, high liquidity, favorable tax treatment for long-term. Real estate, varies widely, medium-high risk, very low liquidity, tax benefits on home loans. Gold, 10 to 11% historical returns, low medium risk, medium liquidity, taxed as capital gains. There's no single best option. The right mix depends on your goals, timeline, and risk appetite. Here's historical data from Indian markets. Sensex has grown from 100 in 1979 to over 80,000 today. That's roughly 16% annual compounding over 44 years. Nifty 50 has given about 12% CAGR since its inception. But look at the journey. There have been crashes of 50 to 60% in 2008 and 2020. Yet patient investors who stayed through these crashes have been rewarded. Gold has gone from about 200 rupees per 10 grams in 1980 to over 1 lakh today. Real estate in Tier 1 cities has multiplied many times. The lesson? Long-term investing in quality assets has always been rewarded in India. Module 3. Key takeaways. India offers multiple asset classes for investment: debt, equity, real estate, and gold. Each has different risk-return liquidity characteristics. Fixed deposits are safe but barely beat inflation. Equity offers the best long-term returns but with short-term volatility. Real estate needs large capital and has low liquidity. Gold is good for diversification but doesn't generate income. The right approach is to spread your money across multiple asset classes based on your goals and risk tolerance. Now let's learn how to evaluate these investments in Module 4.